This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gordon Long with GordonTLong.com, and I have with me this morning again, Andrew Joseph, who is no stranger to our Trigger Webzine subscribers. Andrew is principal of Golden Phi, publisher of the Triggers Media Publications, Inc. Good morning, Andrew. Welcome to Macro Analytics and our second session on this month's analytics discussion.
Good morning, Gordon. Thank you for having me back. It's great to be here.
Andrew, we're going to talk about macro drivers this morning. Any points you want to make before we start regarding how you're using the macro drivers as part of your regular technical update service at Triggers?
For sure. Every graph now that we try and put out on our website, especially on the weekly, we include the driver that's affecting what we believe is affecting the chart in question. And I bring those as well down onto the daily and hourly charts and try to show how the interconnection between, for example, the dollar and the SPX and what's going on and how these things are driving. And then into the triggers on a shorter time basis and what's going to be probably the most next high-level probability of where we're going and where we've been.
The graphics you see on your screen shows the overall filtering and analysis process we go through at Gordon T. Long, which culminates for traders and serious investors, position investors with the Triggers service. Anything you'd like to add on this particular chart, Andrew?
Well, it's your fine work on all the macro and figuring out what's going on around the world that allows us to identify these drivers, which again brings us into the triggers and allows us to put out our publication here, which I'm doing on a monthly basis, and it summarizes the 400 plus pages of information plus all the information on slides and interviews, the great conversations that you're having. Try and put all that down into a smaller document so someone can come and do their due diligence in a quick and concise manner.
Andrew, before we begin, I just need to quickly take care of some mechanics. We have slides to guide our conversation, as we typically do. I'm going to ask our listeners to open the slides to full screen viewing. You need to open the slides to full screen to properly see the detail we will be discussing. There's an icon in the bottom right corner that by clicking it will do just that. The slides will then automatically advance as we go along. There is a box below the slides where you can make comments or ask questions. We're presently testing this feature, so hopefully when we have you back, Andrew, questions we get we can address. And both vehicles, SlideShare and YouTube, have this facility. We left off with this slide in our last session as a bridge to the macro drivers. I put this chart together to recap the highlights from our macro experts this month. And they included, amongst many things, but certainly expect a weakening euro in the short and intermediate term. I believe long term also, but certainly in the short, intermediate term. Expect a volatile yen and therefore a volatile carry trade. Expect a shrinking U.S. consumption growth rate. I'm not saying its consumption is going to shrink, but at the rate at which it's going to grow is dramatically slowing. And for those who remember your calculus, it's always the first derivative that's the issue. Weakness in industrial commodities complex, to expect that. We're already seeing that. I know, Andrew, you're seeing that in some of your gold and silver charts, are you not?
Definitely. Very weak. Some major supports being broken.
Expect shrinking real economic growth in the developed countries, and we're seeing the PMIs, GDPs all around the world are near 50 or in many, many cases below 50, representing contraction. I showed this last month, and I'd like to revisit it for those who might have missed it, and that is the absolutely criticality to all of the technical analysis of whether the central banks in a coordinated fashion continue to inject liquidity and at what rate and what amounts. And as you can see from this chart, all of the ECB, Bank of Japan, Bank of England, Federal Reserve have all been taking their swing at it. And as you notice, what it is they're working in a sequential manner. You can see them one after the other. What you need to really notice is two things. One, they're getting closer and closer together along the bottom axis, as is represented by the 1 through 5 labeling. And though it doesn't show it, it's getting exponential. It's actually growing because it doesn't show the cumulative amount of them adding together here. So how do they stop that as they say they're going to? They can't. The question is, not only is it going to increase, but the rate at which it's going to increase. And what we're seeing here, this is showing just the United States Federal Reserve with the litro element from Europe added in, overlaid onto the movements that we've seen in the S&P. And if you total this, we've got 1,158 S&P points directly attributable just to these quantitative easing injections that we've had, or we wouldn't have had increases in the S&P without it here since the bottom in March of 2009. And so that's pretty dramatic, is it not, Andrew?
Yeah, and one of the reasons that's important to consider is because that's not really real. It's got to correct those points have got to come back somehow. This isn't, it's fake. It's been pushed.
And you know, as a technician, you know that you can always expect any kind of retracement and consolidation to give you a 38.2% Fibonacci retracement. You agree with that?
For sure. At minimum, you can expect that.
That's my point too. It's minimum you would expect that. Typically, 61.8% you more than not get in any kind of corrective action to allow you to advance. Without that, you do not have a platform to grow. So even assuming markets are going up, they don't typically go without that kind of correction. We have yet to have a 38.2% correction, Andrew. How long can you keep going without that? That's the question here. It's defying all technical analysis so far.
Yes, yeah, it makes it difficult at times because although the technicals are saying something and you would expect a reversal or an action to occur, but because of the macros and it's because it's not, it's being pushed and it is fake, the technicals are blown out of the water. And unless you can see from a macro side that the work that you're doing as to where this is coming from, the effect it's going to have, and you're relying solely on the technical analysis, it's gonna hit you from the left side, and you're not going to see it coming.
What happens is you're forced to play the momentum game. So if you're not in the momentum game, you're losing money. But unfortunately, what happens is the momentum game changes on a dime. It's a major gap down, and you get an island, and before you move, you've retraced 8%. And effectively, that's almost what we've had over the last month. We've had a very rapid decline. And we'll see probably a reversal as soon as one of the central banks signals a money increase going back up. That doesn't mean it'll be sustained unless more of the central banks jump in. That's certainly what I'm expecting. And what this chart is showing is that the impact of the money printing is having less and less effect. And this is the bigger concern. So not only will it have to be larger in a more coordinated fashion, but it's questionable just how much real push and elevation that we're going to get in the next round of quantitative easing, or whatever it'll be called. You can be assured it won't be called quantitative easing 3. Going to the next chart, Andrew, this chart makes things pretty clear to me of what has been going on. It's about the changing global liquidity pumping, not just from the central banks, but in something that is referred to as the carry trade. And this chart on the bottom goes back to the dot-com bubble burst in 2000, right down there in the bottom corner. And then we had this massive reflation trade, which not just pushed up U.S. equities, but really, I think more so in Europe, the expansion of debt in Europe that allowed the peripherals to expand, and now they face the piper on that one. And you can see that it went up, and then this is the euro-yen cross, and the yen being the carry trade that's been financing the European expansion, in my estimation. And you can see how beautifully it's coordinated with the top in 2008 when that dramatically reversed. We've fallen down, and now we've got another reversal as problems are starting to stem with the fact that it's not just the weakness in the euro. But what's happening now is that the yen has become too strong. The yen in Japan, and we've talked about this in previous shows, is now facing very serious problems. And that is current account balance problem and a negative deficit trade balance, which they've never experienced. So for Japan to finance its debt, which it's had the luxury, it's holding the biggest debt in the world, it's been blessed, but these things are coming apart at the seams right now, and this is going to have a tremendous impact on the carry trade. This chart shows you the magnitude of the Japanese debt as being the largest debtor in the world. And I don't think a lot of people are fully cognizant of that. Sony just laid off 10,000 workers here a few weeks ago. It's an indication of the severity of the problem. 512% total debt to GDP shown in this chart, 226% just the sovereign debt, and they're talking about printing more. Who's going to lend it to them? How are they going to keep doing? Who's going to finance this debt? If you go to the next slide, what we have here, and you've seen this chart in previous session, and it highlights the yen volatility we identified as a potential macro driver. And notice that red circle down at the bottom. When you start to see these breaking channels like this, and I'm not suggesting it's going to keep going up. It may be just as volatile in reverse and head down. But that's what's going on, and I encourage our listeners to pay a lot of attention to what's happening in Japan, even though everybody's looking at Europe. I think Japan is going to be bigger problem than Europe and will soon grab the headlines and bury the problems in Europe. And when I say soon, sometime this year into early next year. Any comments on that, Andrew?
Yeah, with the increased volatility, as you say, it's going to continue to increase, but that just provides more opportunity for those who like to know what's coming and can see it happening.
It's one of the things we're watching on our drivers very close. We're watching the euro-yen cross. We're watching the dollar-yen and then the dollar-euro. And we can clearly see support and resistance levels at play, which goes right through the equity markets.
Some of these charts that you've been showing, the one that's in front of us now, the technicals, you may think that actually because of the larger triangle that we're seeing there, that the pennant, that we might actually continue down with that. That's because we have a downward trend. But again, you have to factor in as the work that you're doing with the macros and what it's saying, and that it's actually probably not that the pennant with a downward, but it's actually going to be it's a reversal pattern.
I think that reflects right now, Andrew, frankly, in our gold charts too.
Exactly, yeah.
Because we're seeing the same kind of thing in the gold chart, which says get out of gold, get out of Dodge from a technical standpoint. Is that a fair statement from what you're saying?
Definitely. Major supports have been broken, and there's nowhere bottom underneath us to go. However, again, you have to factor in what's going to go on macroly, and it changes the dynamic of the chart and what you're actually looking at.
Yeah, this may be the time actually to back the truck up for gold and silver. I'm not saying to do that. I'm saying what we're watching very, very closely right now. Because when the central banks do make this signal, they're going to print more money. And if in fact it has to be the degree that I think it needs to be right now, especially in my comments on the first show with the amount of corporate debt that's got to be financed and the money isn't there. When this begins to be signaled, I don't say when they've actually done it, just when they signal it, you can see precious metals reverse on a dime. And if they move, gold will not be moving at $10 a day. It'll be gapping at $100 an ounce moves. You'll be at $22.50 on gold in a bat of an eye. If in fact they come out as aggressive as I think they must. If I'm wrong on that, and time will tell, then in fact it may play down and we may see a lot more weakness, because certainly the central banks want that to happen. I don't think they have any choice. I think the cards have been dealt. All they're doing is buying time on that. I don't think you need to make your move quite yet. I think you need to watch closely the central banks for their signals, but you're going to have to pay close attention to it. Moving along here to the next one on the U.S. dollar chart, our global macro tipping points, what we call the GMTP service, has been indicating the following outlook. The events in Europe continue to precipitate a temporary flight to quality. The U.S. dollar and the U.S. Treasuries were the recipients of this flight to safety, as the U.S. financial markets were seen to be safe haven relative to the other options. These global macro developments temporarily halted the ongoing long-term weakening in the U.S. dollar. And as we wrote as far back, I guess, as November, any perceived solutions to the European sovereign debt crisis, even if they are kick the can down the road policy, would result in the U.S. dollar weakening. A weakening dollar means it takes more U.S. dollars to buy the same S&P basket of stocks, and hence stocks denominated in U.S. dollars would rise. This occurred in Q1. And resulted in a major counter rally in the U.S. equity market, which has now simply fizzled. Though the problems in the EU continue to worsen, the ECB's, what I'll call litro gimmick, has temporarily dramatically reduced the perceived risk. That, however, is now changing and changing rapidly, as we've seen in Spain. The spreads between those banks who have participated in litro and not. And so we have the beginnings of a very serious credit spread problem in Europe. Going to the next chart, I'm showing the euro-US dollar cross. This is another element, as I mentioned, that we're watching very, very closely. The euro will weaken against the US dollar, in my mind, in the short to intermediate term. The US dollar index will advance and US equity markets will come under pressure. The only solution for the EU is the ECB to print money. The realization, which is beginning to occur as Germany capitulated last week, are willing to accept higher inflation, which is saying they're going to allow the ECB to print, which has been the stumbling block, will mean that the European monetization will further weaken the euro and the US dollar will resume its advance. The present strategy in the EU is to change the treaty accord to put EU teeth into countries having to take stronger actions to bring their debt within the EU targets. The recent elections in Europe, and specifically in France, I believe calls this now into question. I think that's going to go by the way. I think they're just going to immediately demand that Draghi take action. And that's Holland's new president of France, clear mandate. He ran a platform on that. No solution is given on how they do that other than, how they're going to fix their problems. And even this whole concept of austerity just hit a brick wall in France and Greece, which almost assures economic weakness and possible collapse going forward. The only way out is, with all the countries now voting against austerity, is to print. The European Central Bank will become the lender of last resort. That's something the Federal Reserve is, but it's never been the mandate of the ECB. That is a dramatic change. They will print the money, and I mean in vast amounts. As we've been saying for, 90 days now, Andrew, I expect Spain and Portugal to soon trigger the next and much more serious round of EU crisis. Spain is in free fall, being papered over with the litro. That's going to explode on the scene here, I think, within a few weeks.
I think back in November, December, we were talking that this was just the beginning then, that we were seeing in Greece at the time was just the beginning of what's going on in the EU, and that it was just starting to roll. And now you're saying we've come into the next Spain.
We're at about, I would say, the top of the third. This game could go into overtime. We're in the early innings of this. We haven't even got to the sixth inning stretch yet.
Just getting started.
What's happening is we're just beginning to see the magnitude of the cracks. We've got a whole round, Andrew, when people start to understand what's been going on with something called contingent liabilities. We have another whole round when we discover where that $700 trillion of swaps has been placed and which governments at the federal, sovereign, the local city levels, right down to cities such as Milan, what they've been doing to make their books work. As these things crack and unfold, and they're being forced to unfold, and I think I mentioned in our first session my concerns on this month's Bank of International Settlements on what's been happening with the cost of the swaps and changes that are happening there in the third-party risk. These are the indications that this is going to crack and get worse. But as I think I've also mentioned, as bad as it is in Europe, the thing I'm most worried right now is Japan. From a macro standpoint, though, that's a little further out. I don't think we can fix Europe. There's just no way. When Japan would be unstoppable at that point if something happened there. Going to our next chart, Andrew, is the bond market. In the short to intermediate term, we should see interest rates fall even further. We've got a 10-year bond, Andrew, right now 1.8%, which means the prices will go up, as shown here, as yields go down, which will mean further strengthening in the U.S. dollar. Remember, the Federal Reserve is committed to and must achieve something called financial repression based on the severity of the U.S. debt levels. What this effectively is doing, Andrew, is it's penalizing you to be a saver. It's really taking your money as a saver and forcing you to make riskier bets. You can't get any interest rates, so you're going to put it in something where you think you can get some kind of return. For example, the stock market. That may not turn out to be your best investment over the long term.
It's a false reality with the market because people believe they're getting 5 or 6%, just say steady on dividends and believe that they're winning out again, but the inflation's over 10%, so it's just false. It's not really what's going on.
With the debt cliff coming in January and the dramatic increase in taxes in the United States, I'm anticipating significant increases in dividend-paying stocks, because the stocks that are actually moving are those who are paying some level of dividends. and I can see the next round coming there, which will dramatically impact the markets. I think the bottom line from a market standpoint, Andrew, and I don't know if you agree with it, I think the days of buy and hold are history.
Yeah, that was gone a little while ago, I think.
If you want to be in the equity markets, you have to be a fairly nimble player. Not saying you necessarily have to be a trader, but you certainly are not holding positions for long periods of time without paying attention to them.
It doesn't pay off just like throwing your money in the bank and hoping to get 1 or 2%, but you're not keeping up with inflation. Well, the S&P is not really keeping up with inflation either, and neither is getting your dividends at a solid 5 or 6% when inflation's over 10. You got to figure something else.
Inflation right now is minimally 10.2% if calculated properly. And exactly. Tell me where you're getting 10.2%. If you're not getting 10.2% right now, you're losing ground. That's the problem. And you're losing ground at a phenomenal rate. Going to the next chart, we've noticed over the last 4 months during this liquidity and currency devaluation-driven market rally that a clear possibility now exists that the central banks may be able to, one, continue to keep the equity markets up despite historic low volumes, minimal public participation, and an increasing disconnect in valuations as seen by mysteriously expanding PE valuations. And second, further lift the markets in nominal values while witnessing a relentless collapse in real values. This chart shows the right shoulder being put in at possibly too higher levels at an upper parallel channel boundary condition drawn in black and shown with the lower red H, and at an upper resistance trend line shown in gray and shown with the higher red H. First, however, our rounded top will still need to correct to lower levels marked with the blue L for lower. Going to the next chart, our proprietary analytics are strongly showing the potential for higher nominal highs through the convergence and alignment of a number of technical studies. A GON target which aligns with a completed megaphone top. Second, a trend line that centers the GON analysis. 3, a decade-long Fibonacci time extension that centers the GON analysis. This is presently a high probability, but is completely dependent on another round of massive global monetary stimulus, which will further separate nominal and real values. Markets will fall from a rounded top unless this happens. I think this chart is about as clear as I can make it here this morning. The market is elevated because of global liquidity, and where it goes depends on whether the debt drug pusher is going to show up again. I'm not sure who is more addicted, actually. Andrew, I was thinking that during my session with Charles Hugh Smith, I mentioned the role of the Fed and central banks was always to take the punch bowl away from the party just as the party got going. Well, today's central banks have knowingly or unknowingly become the bootleggers to that party, and that's the problem. If you go to the next slide, if the bootleggers shows up, we get this green final lift as part of this dilutional distortion. If he doesn't, then we get this chart from our rounded top scenario, which we've had in place here for, I guess, now close to 18 months. And so we still think there's another lift with this final round of printing. But if for some reason they don't, and I can't imagine that they cannot not go ahead with it, then this is the chart you should be looking at. Andrew, we're up against our hard line. As usual, we never have enough time. I thank you for joining me for this three-part series. I look forward to the questions our listeners send us. A reminder to our listeners to add your questions and comments directly below the slides before you sign off. Andrew, any closing comments you want to make on what we've talked about here this morning and how our listeners might learn more about what you do and your writings and your site?
Thank you, Gordon. Yeah, I look forward to our next session where we're going to try and take what we talk now and bring it down even a level again and talk about triggers. And people can find out more about our site and what's going on at www.triggers.ca and take a look at some of the things we got going there. We'll just be getting started, but like we said, next session we'll show you how that we're taking this great work that you're doing, Gordon, on a macro level and bringing it down one more step and try and make it applicable for trading.
Looking forward to our drill down session next, Andrew. Talk to you then.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.